Good afternoon and welcome to the HALMA investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we would like to submit the following poll, and if you would give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand over to Charles King, Head of Investor Relations, and Mark Ronchetti, CFO from HALMA. Good afternoon.
Good afternoon. Thank you very much, Mark, and a very warm welcome to everyone listening into this presentation today. Mark has already introduced us, but just to reintroduce us as a team, I'm Charles King, the Head of Investor Relations at HALMA, and I'm joined today by Mark Ronchetti, our Chief Financial Officer. In terms of the agenda today, it's a pretty simple one, as you can see. As this is the first time we're presenting on the Investor Meet Company platform, I thought it was appropriate that we give it a brief introduction to HALMA to start off with, so I'll spend about 10 minutes on that. And then I'll turn over to Mark, who will discuss two areas. One is our sustainable growth model, and then he'll give an overview of our first half 2022 results. And following that, as Mark said, we'll have time for some questions. So just in terms of that introduction to HALMA. So as you can see, we're a global group of life-saving technology companies, and we provide innovative solutions to many of the key problems facing the world today. Those problems include areas like climate change, the increasing scarcity of natural resources, the pressures that come from growing, aging, and urbanizing populations. Our purpose, that you can see on the slide there, of growing a safer, cleaner, healthier future for everyone every day, defines our culture and ensures that we focus on providing solutions to challenges that are essential to people and the planet. And I'd like to now show you a video that brings that purpose to life and shows how we create value as a business.
We are a global group of companies,
united by a purpose.
A purpose that keeps us moving forward.
We know that every problem has a solution.
And that's what motivates us.
When we face the biggest problems of our time,
Like water pollution,
chronic illness,
and climate change.
We know it isn't easy.
But that's why we do it.
it's in our DNA to work the problem.
The problem of how to make roads safer.
How to make the air we breathe cleaner.
How to keep an aging population healthier.
We see real problems.
We look at each one from a different angle.
And we innovate to solve them.
Working with each other.
And with our partners. Every year,
We're enabling 200 million tests to keep people's water clean and secure.
every day,
Our technology helps support thousands of life-changing surgeries.
And every minute,
Our technology is supporting the change to green energy.
just some of the impact that's made us one of Britain's most admired companies.
and we'll continue to work to find solutions
To grow a safer,
cleaner,
Healthier future.
for everyone, every day.
So let's start to put some numbers around what you've just heard in the video there. And here's just an overview of some of the key numbers about HALMA. We're a global group of around 50 companies, each focused on niche markets with strong underlying growth drivers. We have over 7,000 employees. We operate in over 20 countries, and we provide our products and services in over 100 countries. We're listed in London, and we've been a member of the FTSE 100 Index since December 2017. In the last financial year, to March 2021, we delivered revenues of just over £1.3 billion and profitability of £278 million, which was an increase over the prior year, despite the challenges we saw from the COVID pandemic. And Mark will talk a little bit about that in a moment or two. And we were also able to continue our almost unique track record of delivering dividend growth of 5% or more for more than 40 years. And we're proud of our ability to deliver robust financial performance in terms of growth and returns, whilst also ensuring that we meet the broader needs of stakeholders. This has been recognised not only by the financial markets, which value us at around 9 billion, as you can see there, but also by a broader range of stakeholders who in January 2021, for example, awarded us the accolade of Britain's most admired company. And actually the most recent most admired company survey from Management Today just came out a few days ago, and we were once again in the top 10 of the most admired companies in the UK. So those accolades keep coming. That's the third year running we've been in the top 10. Moving on just to have a look at our markets. I've already mentioned that we're a global group of companies, and this slide shows our main markets by geography on the left and by our three sectors on the right. Looking at the left-hand chart, you can see that the US is our largest market, representing nearly 40% of our revenues, followed closely by the UK and Europe, which together are over 1/3 of revenues. Other mainly developing markets in Asia Pacific and elsewhere around the world, including in the Middle East and South America, represent together around 1/4 of our revenues. We have three sectors aligned with our safer, cleaner, healthier purpose, with safety being the largest at 45% of revenues in the last financial year, and medical and environmental and analysis, each accounting for nearly 30% of the revenues each. This slide shows the market areas in which we operate. Our growth in these markets is underpinned by very long-term and fundamental trends. Global demographic changes as populations grow, age and urbanize, climate change, and the need to address the increasing scarcity of and pollution of life-critical resources, such as water and air, as you heard in the video, and the growing demand, of course, for high-quality healthcare globally. Set out under each of the headings of safer, cleaner, and healthier are our main areas of operation. Let me bring this to life a bit by describing some more of these in a bit more detail. Starting with safety. In the safety sector, our two largest business areas are fire detection and people and vehicle flow. They incorporate two of our largest companies, Apollo Fire Detectors, based here in the UK, and BEA, based in Belgium. Apollo is the largest of our 7 fire detection companies. Its solutions protect people from fire in over 100 countries around the world. And we also protect a number of iconic buildings. You can see there the Shard, but amongst others that we protect are the Albert Hall, Buckingham Palace, and the White House. Overall, we estimate that Apollo's fire detectors keep people safe in buildings covering an area of 5,000 square kilometers. That's an area equivalent to twice the size of Luxembourg. Our other fire detection businesses around the world include AMPAC in Australia, which has a similarly leading position to Apollo. And you can see there the Melbourne Arena, one of the iconic buildings that they protect down in Australia. And two more recent acquisitions, Ramtech, which provides temporary fire detection systems for use, for example, in construction sites, and FireMate, which provides a software solution for fire system installers to ensure that they keep systems up to date. In people and vehicle flow, we have two companies. BEA, I've already mentioned, a leading manufacturer of sensing solutions for automatic door systems, whose products can be found around the world, everywhere from your local supermarket, from your office, to transport hubs and large industrial and logistics facilities. And in 2018, we added Navtech to our portfolio, which uses radar technology to keep critical infrastructure, such as airports, safe and secure, and also to improve road safety on increasingly busy motorways and road tunnels, including, as you can see here, the M25. Moving on to environmental and analysis, and highlighting two market areas, water analysis and treatment, and gas detection, which are key areas in addressing climate change, waste, and pollution. HWM is one of our 7 companies operating in water analysis and treatment. It helps utilities monitor the performance of water, wastewater, and gas networks. Its leak detection solutions, for example, enable UK utility companies to save billions of gallons of water every year through the prompt detection of leaks. And you may have seen in the video Palintest, their water analysis technologies are used in over 200 million tests annually. And we supply, of those 200 million, we supply around 5 million water quality tests each year to partners working in international relief and development. In gas detection, we have 3 companies, Crocon, Sensitron, which are focused on detecting hazardous gases, mainly in industrial environments, and Sensit, which enables natural gas utilities, distribution and transmission companies to detect leaks, preventing emissions of what is a potent greenhouse gas. So natural gas is mostly methane, and that is a very potent greenhouse gas. So clearly stopping those leaks is very important. Overall, we estimate that our gas sensor products protect the safety of more than 250,000 people every single day. And finally, medical. In the medical sector, our products support more than 7 million surgeries a year. MST, for example, provides instruments for eye surgery, enabling treatment of 2 major causes of preventable blindness, cataracts and glaucoma. And Permapure's products in oxygenation have been in high demand during the COVID pandemic, increasing patient comfort during ventilation. In health assessment, on the right-hand side of the slide, we supply over 1 million diagnostic products a year, for example, in blood pressure monitoring, where Suntex products enable accurate measurements in challenging environments, for example, in air ambulances or when a patient is running on a treadmill. And then on the bottom right, you can see Keeler, which has supplied innovative ophthalmic instruments for well over 100 years. If you've visited an ophthalmologist, it's quite likely that they've used a Keeler product in their diagnosis. So that's a very brief introduction to Halma. I'll now hand over to Mark, who will describe our sustainable growth model.
Thanks, Charles. Hi, everybody. So yes, I'll be running through shortly our sustainable growth model in terms of how we deliver. I guess to start the section, just worth an overview of the output. So an overview of our performance over the last decade. And as you can see, even with that challenging year in 2021, which included the peak of the effects of the COVID pandemic, we've delivered double-digit revenue and profit compound annual growth over this period. Further to that, and coming out of the pandemic, we've talked before, but absolutely believe that the pandemic has further reinforced the value of our sustainable growth model, the benefits of our clear purpose and strong culture, our positioning that we take in global niche markets with those strong long-term growth drivers, and the flexibility of our business model, which allows our companies to be agile and responsive in fast-changing markets. So I'll pick up on the key elements of this model as we work through, and of course, how has that model enabled us to sustain that strong performance over the last decade? So if we start with our headline sustainable growth model, and everything starts with our purpose of growing a safer, cleaner, healthier future for everyone, every day. This purpose sits at the heart of our sustainable growth model. It defines our culture and ensures that we're focused on providing the solutions to challenges that are essential to people and the planet. We describe and talk about our culture through the HALMA DNA. This gives us an inclusive, motivating and stretching ambition for everyone at HALMA to play their part in delivery of our purpose. There are then 4 other core elements of our sustainable growth model, all interlinked with each other and with our purpose and of course with our DNA. First up, we have our growth strategy, which is to focus on those niches in global markets, those niches that have resilient long-term growth drivers. We sustain and expand our growth opportunities through continuous investment in organic growth and in acquisitions. We then move on to our business model, the way that we're structured. This enables us to be agile and responsive to changes in technology and in our end markets. In the longer term, this gives HALMA that agility to evolve our portfolio by buying and selling businesses. And then in the shorter term, it allows our companies the freedom and their own resources to be innovative, agile and responsive to their market changes. All of this supported by the expertise of our centrally funded HALMA growth enablers. For this model to work, we need to constantly ensure that we've got the very best leaders and people for the future. Great examples this past year have shown how effectively we manage our leadership succession as we grow, and this included a new chair, new sector CEOs, divisional CEOs and company MDs, and we continue to build a highly inclusive and diverse culture by setting ambitious targets at all levels. Finally, we have our sustainability framework. This prioritises the areas of sustainability which are most material for HALMA and supports our companies to achieve them. We've been really disciplined over a long period to evolve and align all of these elements collectively, and this has enabled our companies to create value through many different circumstances. For example, like our peers, in the first half of this financial year, we experienced on the one hand substantially higher demands and accelerated pace of change in our markets, and on the other hand, increased macroeconomic uncertainty and supply chain, logistical and labour market disruption. Through our sustainable growth model, HALMA companies are empowered and able to meet these challenges in a variety of ways, either through finding alternative suppliers because they have their own procurement functions, or by designing in alternative components because they have their own R&D capability. They can increase contingency stock of key components where they're able to because they have their own manufacturing operations and their own individual balance sheets. And of course, by selectively increasing pricing because they have their own channel to market and their own individual strong market positions. So now let's look a little more deeply at our growth strategy and our financial model. As I mentioned, our choice of end markets results in a highly sustainable financial model. We have a disciplined focus on markets which have resilient long-term growth drivers and market niches that offer consistently superior organic growth and high returns. We seek to have leading positions within these niche markets and to sustain them through continuous reinvestment. This supports our delivery of consistently strong growth and high returns, but it also means that we're highly cash generative, and this allows us to maintain modest levels of leverage while making substantial investments in future growth and returns. If I think about our capital allocation, the first priority of this continuous reinvestment is back into organic growth in R&D and product innovation to maintain those strong market and product positions and drive growth and maintain high return on sales. That strong cash generation also allows us to make value-enhancing acquisitions in core and adjacent markets to expand our growth opportunities and our geographical reach. And finally, while allowing us flexibility to invest, it also enables us to sustain a progressive dividend policy for our shareholders, as we heard from Charles, as we've done now for more than 40 years. So let's have a look at how we create value. Our sustainable growth model creates value for our stakeholders over the long term through delivering the combination of growth and returns that I've just discussed, but also positive impact. That positive impact that we have on the world through how we operate and the solutions we provide, as you just heard from Charles. There's 5 key areas which are the focus for our investment and resources. Number 1, organic growth. Secondly, M&A, talent, our sustainability, and of course, our infrastructure. In the first half of this year, so just kind of putting this into context of the short term, we further increased our investment in all of these areas to sustain our growth and returns and positive impact over the long term. So as I say, let me just finish by bringing that to life with an overview of our first half results. Now, I was really pleased to present at the half year that we delivered a strong performance in the first half. We had a particularly pleasing financial performance given the ongoing volatility faced by our operating companies. So let me walk you through that, and I'll start with the headline performance. As you can see, we delivered record half-year revenue and adjusted profit, with strong growth across all sectors and all major regions, high rates of organic growth and a good contribution from recent acquisitions. If we look over that longer term, it's great to see that compound average growth rate of both revenue and profit are in excess of our internal KPIs at 11%. Looking now across kind of the key areas that we assess at our half and full year results. So firstly, starting with growth, it was good to see revenue was up 19%. This supported by continued good order momentum. Our adjusted profit increased by 27%. And it's also worth noting that revenue was 13% higher and profit 20% higher than in the same period 2 years ago. Because clearly the comparator here was in the peak of COVID, with our financial year running from the 1st of April through to the end of March. There was an impressive 74% increase in statutory profit. This did include the gain on disposal of Texcom, one of our businesses, in the second quarter. That said, even with these very high levels of growth and the consequent demand on working capital, we continue to deliver solid cash generation and increase investment. Our cash conversion was 85%. We maintained a strong balance sheet with gearing unchanged from the year end at 0.7 times. Our R&D spend increased in line with our growth and was maintained at 5.6% of our revenue. And it was also pleasing to see that we were able to complete 10 acquisitions in the first half of the year, with a spend totaling 107 million in the first half. And then since our half-year results, we've completed a further 2 acquisitions, taking our total spend for the year to date to 146 million. As a result of that strong growth, our stable gross margin and the slower than expected return of variable overhead cost reductions where we had made savings in response to COVID pressure on the top line, we delivered high returns, with return on sales increasing to 21%, which is actually towards the higher end of our target range of 18 to 22%. Our ROTIC, a key measure for our business, was up more than 2 percentage points to 14.9%. This reflecting the benefit of the strong constant currency growth. And then overall, I guess you take a big step back and you think through this strong performance, our financial strength, our confidence in the future, supported an increase at the half year in our interim dividend of 7%, which maintained that long-term progressive dividend policy. So now just having a look at our performance against our financial KPIs. Overall, really pleasing and excellent performance in the first half of the year. As I said, with record revenue and profit growth substantially ahead of our KPIs, and a solid cash performance, especially given those working capital that's been required to support that exceptional level of growth. And this growth was delivered alongside high returns, with ROTIC benefiting from those strong levels of constant currency growth and return on sales, as I mentioned, above average levels. And of course, then this short-term performance was delivered whilst maintaining those high levels of investment, both organically with the R&D spend and also through acquisition. So to summarise, the core elements of HALMA's sustainable growth model continue to enable us to make substantial progress in both the short, medium and the longer term. As you've just seen, we delivered record first half revenue, profit and dividends, and continued strong returns, supported by that agility in our companies in what remain fast-changing markets. We further increased our strategic investments to sustain our growth, returns and a positive impact over the long term. And we've got a healthy M&A pipeline covering all three of our sectors. In the half year, we updated in terms of the outlook, and we said that our shorter term trading remained positive. This supported by a strong order book, and order intake remained ahead of our revenue in the same period last year. So taking all of these factors into account, we said that we expect to continue to make progress in the second half of the year. So with that, the summary of who we are, what we do, how we execute through our sustainable growth model, and hopefully some reinforcement through our half-year results. And we've now got some time for some Q&A. So thank you for listening, and we'll hand over for Q&A.
That's great, Charles. Mark, thank you once again for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. Just please simply type in your question and then press send. But just while Mark and Charles take a few moments to review those questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard, and we'll notify you by email when they are ready for your review. Charles, obviously, if I could ask you to open up the Q&A tab, you'll see investors have submitted a number of calls throughout today's presentation. If I may, ask you to read out the questions, perhaps who it's from, and give a response where it's appropriate to do so, and I'll pick up from you at the end.
Great, thank you, Mark. I'm very happy to do that. So we'll start with the first question from Peter A. Thank you for the question. What is the split between organic and acquisition growth? Is it 50-50, Mark?
Yep, no, more than happy to I guess put a little bit of colour onto what I referred to as our financial model. So our stated aspiration is to double the size of the group every 5 years. To enable us to do that, we need to grow at 15% per annum, and we split that 15% growth 7.5% organic and 7.5% through M&A. So we're looking to double. As you saw in the slides, with that aspiration, we've been achieving sort of 11-12%, and it's largely 50-50, a little bit swayed towards organic. The key part in there for the financial model, to come back to that high returns, high cash generation, is that that's a self-funded model. So we're able to deliver that organic growth, reinvest organically, that frees up the cash to allow us to also invest inorganically to deliver that growth, as I say, with an aspiration of 15% per annum.
Great, thank you, Mark. So the next question comes from Simon C. How do you think HALMA has improved as an organisation through COVID from an operational perspective?
Yeah, lots of answers I could give in terms of what have we learnt, how have we improved from COVID. I think the first thing, and I alluded to it in my presentation, is actually, once again, it's reinforced our sustainable growth model, and whether that is those actually, how do we ensure that we remain focused on those long-term growth drivers? How do we ensure that we're in those critical niches which enable us to be critical throughout, enable us in many instances to be mandated through the pandemic. So certainly on the being in the right market, being aligned to our purpose is reinforced. But I think a couple of things more importantly are around then the org design, and in fact the agility that gave us. By in the centre being able to run many models in the beginning, but quickly being able to speak directly to the MDs and the boards of each of our operating companies, sharing the context of some of the decisions that we're making, some of the challenges that we were faced with, but then allowing them, with their deep knowledge of their markets, deep knowledge of their customers, ownership of their own P&L, balance sheet, cash flow, to go and take the appropriate action for their business, meant that we could react really quickly. So I guess the final point around that agility was just how we were able to stand up very quickly away from 9 times out of 10, it's appropriate to operate through our sector structure. So very much you would be operating sector by sector, not by geography. But certainly with the pandemic and the challenges that it caused, there were many more things that were needed to be spoken about on geographical background. So again, just being able to stand up those networks really quickly, put in contact with people locally was a key learning for us and something that we'll continue to leverage when we need to moving forward.
Okay, thanks, Mark. One now about geographic exposure from Matthew R. With nearly 40% of your revenue from the US, how do you see that balance moving forward? I guess that's the balance of geographies across the business. And how will you look to balance the geographic exposure through M&A?
Yeah, good question. And certainly sort of wind back 10, 15 years. And I think then the group were looking at how does APAC and in particular China become a strategic priority for the group, and how do you grow in the region? And at that time, interestingly, they set themselves a target of X% of the group's revenue to be in markets outside of UK, Europe, and the US. But quickly, what they learned was because we were in such good markets locally, we were able to generate really good growth in those home markets where we already had a good standing. So it wasn't about how do I actually get a percentage of the group's revenue in a different region, but very much how do we get faster growth in the new regions because we can deliver strongly. Moving forward, we've been very successful. I think Asia Pacific in particular is a good opportunity for us. And if you think with China, with their latest 5-year plan, so much more now focused on a greener China, a transition into a more sustainable China, that has to be an opportunity. We've grown really well over the last 10, 15 years organically, locally. But what that has now shown us in our experience actually in the US is that to really accelerate your growth, exactly to your question, you need to be looking at inorganic growth in the region. And we now feel that with the number of employees, the number of companies, our hub in region, that's a nice platform for us moving forward. So strategically, we're not saying we need to get to this percentage, but we absolutely see in line with our purpose, if we're going to be safer, cleaner, healthier for everyone every day, then we can look at further expansion internationally.
Perhaps another one on acquisitions while we're on that topic, Mark. With acquisitions an important part of your business model, could you explain the integration process of newly acquired companies?
Yes, of course. I think the start point there is it's relatively light touch, but I think it's almost worth just winding back a step or two in terms of our approach to M&A, which feeds into that integration process. So what we're actually looking to do is, I guess in its simplest form, acquire companies that aren't for sale. So we're looking for successful companies with all of those attributes that we've talked to in terms of alignment, purpose, culture, all of the right end markets, the right financials. We're then looking to build relationships with those businesses over a period of time. And then at the point that they come for sale, HALMA becomes a home for that business. So we're not looking necessarily to go into auction processes. We're talking to on average between 600 and 700 companies at any one time in terms of those companies we're building relationships. That relationship may be as short as 6 months before we look at acquisition, or it could be as long, and I think Charles mentioned AMPAC earlier. We knew Alf, the owner, for over 20 years before acquiring his business. So by building up that relationship, part of what we call our transformation plan at the outset, firstly, what you're doing is laying out the future cash flows. Secondly, then, is what are we doing on the integration process? So the key focus of the integration is twofold. First up, it's how do we ensure that this business has the appropriate governance, control, and compliance culture. With that, we've got a very clear integration process. It's about having the appropriate controls, having the appropriate systems. It's not a consistent system, but have we got the right controls that are owned locally? And then secondly, it's about going back to that transformation plan and saying, when we made the decision to invest and acquire this business, these were the key areas that we were looking at to drive those future cash flows. So how are we performing about even making those investments, making those changes? And again, we track that through. The key thing in all of this is that every business that we acquire, one of the prerequisites is that we have a HALMA employed divisional chief exec who then chair that operating company. And those DCs chair 4 or 5 HALMA companies, and they become a really critical link between the group and the operating company to help them through that integration process.
And perhaps we could do one more on acquisitions, and then maybe I'll answer one and give you a break, Mark. But another one from Peter A. As you grow, is it more difficult to find suitable acquisitions?
Yeah, there's a few facets to that question that we often get asked. So let me just, I guess, answer that question from a scalability perspective. I guess 2 angles there on the scalability perspective. One is, we've got 50 companies. How many could you have if you keep acquiring? The reality is, sort of 10, 15 years ago, we had 40, 45 companies. Today, we have 50. So on average, we're buying 5 or 6 companies a year. We're probably merging 2 together and divesting. So you don't get much of an expansion in terms of the number of companies. In addition to that, our sector structure, where we have the 3 sectors, actually probably enables us to have at least 50 companies in each of the structures. So plenty of bandwidth there in terms of scalability on M&A. The other, I guess, angle then is from a financial model perspective. Surely it becomes harder and harder. You're looking to acquire 7.5%. Surely you'll have to do a transformational deal. And I guess the point there is, even if you just work back the mathematics on that, we're looking to acquire 7.5%. So make the math a little bit easy, 300 million of profit, looking to acquire 7.5%, round it up. You're then thinking, okay, how do we acquire 25%, double that again? You're still only ever really looking, so that's how do we acquire 25 million? Apologies, not percent. How do we acquire 25 million next year? Relatively easy over 5 years. Double that again in 5 years, double again. Long time before you get to having to do a transformational deal. And then finally, I guess the restriction would be availability of assets on the market. And as I say, today we're talking to between 600 and 700 companies. From a scale perspective, we've got everything from sort of 500,000, 1 million profit companies, all the way up to those that are a similar size to the largest companies in the group, so sort of 25, 30 million of profit. Again, we've got confidence that we can grow those companies within the group. So from that perspective, we don't see any end to the runway in terms of acquisition opportunities.
And then maybe I'll just pick up a couple that I can see on my screen here. One from Dennis B. In which sectors would you like to make further acquisitions? I think the answer is across all 3 of our sectors, and that pipeline that Mark talked to is comprised of strong pipelines in each of our individual sectors, in safety, medical, and in environmental and analysis. So a broadly spread pipeline with lots of opportunity, as you can hear. One other question then from Barry M. The discharge of raw sewerage in the UK is very topical and pressure is rising on water companies. How do you see this impacting HWM? Well, absolutely. I think it's a very interesting opportunity for HWM, which historically has been more focused, I would say, on the preservation of clean water, so particularly leak and pressure detection in clean water networks. But over the last few years, we've recognised that the regulatory pressure from the UK water regulator, Ofwat, has also turned to not just preserving clean water, but ensuring that sewers don't overflow and pollute and cause disruption. And we've launched a number of products. HWM has launched products into that to address that issue, particularly a float sensor that remotely triggers warnings to water companies if a sewer is backing up and might be at risk of overflow. So it absolutely is an opportunity for HWM as it moves forward, and one that we would expect to be picked up by the UK utilities to stop those kinds of issues in the market. So yes, it's a good opportunity in wastewater for them, as well as obviously on top of the opportunities that they have in clean water. So perhaps I can turn back to you, Mark, and a slightly different area, looking at health and healthcare, one from Bob M. What are your plans to develop your business in the higher tech and software-enabled segments of health and healthcare? And perhaps thinking of our recent acquisition of Perigen, for example, amongst others, I would guess. But
yeah, it's a good question, because obviously medtech, everything in terms of that technology software in healthcare is booming at the moment, and certainly a lot of interest. I think a couple of things to think about is each of our individual businesses is thinking through with the support of our central innovation digital team. And when I say central team, that's kind of a core team of 4 or 5 experts that are there to support and enable each of the individual operating companies. And what we're then doing with each individual operating company as a start point is thinking through what's the scale of the opportunity, where are the threats, where do I sit today in terms of the digital value chain, where do I sit on what we call our digital playing field, and most importantly, where do I need to get to and by when? And of course, what is the reason for getting there? Is it a defensive play to maintain current market position in growth? Is it a growth opportunity play in terms of if we can get there quicker, there's more superior growth? So that's happening down at the individual operating company level. And then quite rightly at the sector are then looking and thinking, okay, what individual assets are out there that potentially on their own right stand up in terms of their technology, in terms of their growth returns to the business, but how could we use that technology and expertise elsewhere in the group? And to Charles's point, recently acquired Perigen, which is a AI company in terms of birth care. So again, a new market for us, but really interesting both in terms of its standalone operating company, but how can we use and share that expertise wider? So it's very much bottom up aligned with top down. I think the key in all of this is ensuring that we absolutely keep a focus on those niches, absolutely keep a focus on what problem are we solving, for whom, and how much are they willing to pay for it, and ensure that we're competing or working with partners as appropriate.
Okay, thank you, Mark. Perhaps another one here from Peter A, just a very simple one of what's your target ROCE? Do you want me to take that, or so Peter, you'll see that that we publish a set of KPIs. Amongst them is a return on total invested capital. That's a post-tax return, and our threshold for that is 12%. Most recently, we delivered 14.9%, so well above that threshold. And that 14.9% is pretty much double our cost of capital. So what we're really looking to do is deliver consistently strong returns well above and well ahead of our cost of capital in each year. So and that's what we've, if you look at the historic track record of doing that, that's been very strong. So we've we've certainly done that for 10 years plus, and that's the intention to keep doing it. So on a return on total invested capital post-tax, a 12% threshold. We also publish in our annual report return on capital for the company's overall pre-tax return, and that's between 70 and 75%. But we don't set a target or a KPI around that, but we always do report on it, so very visible there. And I think probably to conclude, actually, looking at the questions, I think a general one here from Michael D. What milestones should shareholders look for in 2022? It seems an appropriate one to ask as the last question.
No, very good. And I think really it's about a continuation of that sustainable growth and those aspects within the sustainable growth model. So if you're thinking about that organic growth, that acquisition growth, that continued growth with returns, but most importantly, thinking through how we're now thinking about that sustainable growth model of growth plus returns plus positive impact. And I think the milestones within that, we're very clear about our KPIs from a growth perspective. We've touched on those today. We're very clear about our returns, and with that purpose aligned growth in addition to our sustainable network in terms of reducing our negative impact leaves us really well placed in terms of growth plus returns plus impact moving forward.
Charles, Mark, thank you very, very much indeed. And I think you've taken all those questions you can from investors. Of course, the company will be able to review all questions submitted today. And of course, we'll publish those on the Investor Meet Company platform and notify you by email when they're ready for your review. Charles, Mark, I know investor feedback is important to the company, and I will shortly redirect investors to provide you with their thoughts and expectations. But I guess before doing so, if I may, just ask you for a few closing comments to wrap up with. And then, as I said, I'll redirect investors to provide you with their thoughts and expectations.
Great, thanks, Mark. And I guess first thing to say is thank you, Mark, to you and Investor Meet Company. It's been a pleasure working with you and having our first presentation, so thank you. Also, just thank you to the attendees today. There were some really good questions in there and really focused in on the right areas of our strategy. So to conclude, I think really 3 key areas. Firstly, taking away how we create value as an organisation. And we do that through a combination of growth plus returns plus impact. We then think about how do we execute in terms of delivery of that value creation, and that's through our sustainable growth model. So through everything being aligned to our purpose, the end markets that we're operating in, the DNA, the culture of the group, the org design, the financial returns, all of that is absolutely critical in terms of how we can deliver that sustainable value. And then finally, all of this comes together to come back to a couple of words. It's that delivery of consistent growth and returns over the medium and the long term.
Mark, thank you very much indeed. Charles, once again, thank you to you both for updating investors this afternoon. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of HALMA PLC, we'd like to thank you for attending today's presentation. That now concludes today's session. Good afternoon to you all.